Hello and welcome to this April edition of Amundi's Market Review. In March, the growth narrative has progressively taken the lead, corroborating the risk-on stance of investors across assets. Equity markets continue to rise, Hong Kong and Seng being the only exception. The rationale behind this is macro-founded, so specifically what took place. In the US, we have seen significant progress in the management of the pandemic and the ratification of a massive fiscal boost, while, once unlocked, significant amounts of household savings will likely pull demand higher. We expect the US to lead the economic recovery in developed markets. The Fed will stay accommodative. We expect inflation to grind higher on a temporary basis, with a few consequential spillovers in the short term. The Eurozone lags behind and lockdown measures limit the recovery. We expect a decoupling of US versus Eurozone economic growth. Therefore, the ECB will maintain easy financial conditions. The rebound for Eurozone corporate earnings growth should take place later in the year and is not yet fully priced in by the markets. The fiscal booster is in the pipeline with the Next Generation Fund. Interest rate expectations are unlikely to move higher. Moreover, the value and cyclical features of EU equity markets confirm our preference for European equities. Lastly, we expect the economic growth premium between emerging markets and developed markets to narrow, indicating a more cautious and country-specific exposure to emerging market equities. We are not worried about the Chinese government revising their official growth objective to 6%. We see this as consistent with a sustainable and more balanced economic pattern. Looking now at financial markets. 10-year US Treasury yields closed the month above 1.7%. The Fed is not concerned about rising rates for now. More generally, rates are moving towards higher ranges as growth outlooks materially improve. We are closely watching volatility and the speed of its movements as they represent a key risk to tightening global financial conditions. Usually, higher US rates and a stronger US dollar are a threat to emerging markets. This month, the reaction of emerging market government bonds and currencies has been smoothed by the broader risk-on environment, and we see some further space to perform for emerging high yield and some currencies, in Latin America in particular. The rebound of the US dollar and US interest rates have not been sufficient to temper the risk-on stance of equity markets that have continued to rise in March, on average 5%, with the Hang Seng being the only exception, closing the month at -2%. Before concluding, let's comment on currencies that displayed a large volatility increase. The US dollar appreciated versus the Japanese yen and the Swiss franc, while commodity currencies are still outperforming the US dollar. We expect that the US dollar depreciation trend to pause and in the short term, and the US dollar to stay in the current range between 116 and 118. An abundance of liquidity supports Bitcoin that remains the best performer for the month, up 27%. Gold retraced lower, -2%, and oil prices, despite some volatility during the month, closed almost flat. To conclude, we continue to favor equities, credit, and Italian and Spanish government bonds, the so-called periphery. And on the other hand, we are short US and EU core duration. Selectivity and risk control remain pivotal. Thank you for listening. Please keep safe and see you next month for another market review.